This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Monday here at Ausbiz. I'm Andrew Gagan. Good you can join us as we get going for this new trading week. Let's first take a look at what happened on Friday. A bit of a mixed session with global markets. European stocks, they ended lower on concerns of stretched tech valuations, while on Wall Street, stocks rallied on expectations of a December interest rate cut by the Federal Reserve. However, for the week, the Dow was down 1.9%, the S&P lost 2%, and the Nasdaq lost 2.7%. And the small cap Russell 2000 index, it fell for a fourth straight week. Well, stocks, specifically shares of Nvidia, briefly jumped on speculation that the Trump administration is considering approving sales of the company's H200 AI chips to China. However, the stock fell 6% for the week. That's despite reporting strong quarterly results. Shares in Oracle led Friday's losers in the S&P Tech Index. Alphabet shares extended their record run following the launch of the latest model of its AI model Gemini 3, while Apple rose along with Meta. Eli Lilly rose after the company became the first pharmaceutical company to touch $1 trillion in market capitalisation. And clothing retailer Gap beat Wall Street expectations for third quarter comparable sales and profit, helped by strong marketing-driven demand for its apparel. Well, New York Fed President John Williams, who's seen as an ally of Chairman Jerome Powell, has hinted at a December rate cut, saying, "I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range of the Fed funds rate to move the stance policy closer to the range of neutral." Well, US factory activity slowed to a 4-month low in November because of tariffs on imports. They're restraining demand, leading to stockpiling of unsold goods. And relief for the manufacturers not expected to come soon, with the University of Michigan survey of consumers revealing a sharp drop in buying conditions for manufactured goods, with the survey noting that consumers remain frustrated about the persistence of high prices. Well, US Treasury yields have fallen to a 3-week low as investors raise bets that the Fed will cut rates next month due to a weakening labour market. The US 2-year yield falling to 3.51%, the 10-year at 4.06%, and the US dollar little change, the Aussie trading at 64.6 US cents. Ukrainian, US and European officials met in Geneva on Sunday to discuss a draft US plan to end the war in Ukraine, after Ukraine and its allies voiced alarm over what they saw as major concessions to Russia, while President Trump has said that Ukraine had not been grateful for American efforts during the war. Prior to the meeting, oil prices fell to 1-month low as the US pushed for a peace deal there. Brent futures down 1.3% at $62 a barrel. Copper rose almost 1%. Iron ore up about 1/3% to 104 US a tonne. And gold is weaker, having fallen more than 1% on Friday. Spot gold currently at around $4,065 an ounce. And Bitcoin dropped to a 7-month low on Friday, closing close to $80,000. It has since bounced back to be approaching $88,000 US. Let's get across what we're seeing globally with a focus on New Zealand. Matthew Goodson, Managing Director of Salt Funds Management, joining us again now. Matthew, welcome. Good to catch up with you on this Monday. Let's start with what you're seeing there. How have you opened there in New Zealand?
Typically quiet Monday. We're actually down about 20 points at the moment, but I think once Australia and Asia get in, we may join in what should be a stronger day across the region.
Yeah, of course, we have seen those sharp selling days, most recently last week. Bit of news over the weekend, as I just mentioned there, in terms of prospects perhaps firming there will be a rate cut in the US in December. Do you think that's likely to buoy global markets more generally?
If it occurs, absolutely. I think the probability is now about 60%. So I think very important in the US is they they clearly have this K-shaped economy at the moment where, at the very top end, it's doing quite well, but the great bulk of the economy is struggling. So as far as one can tell, given the data paucity, a rate cut may well be needed there for the bottom leg of that K, if you will.
Now, speaking of central banks and the cutting process, the RBNZ due to reveal its latest monetary policy decision this week. Matthew, what are the expectations?
Market very much expects a 25-point cut which on Wednesday, which will take us to 2.25. Possibly one more cut coming this cycle. Very outside chance they go 50. But they take a long vacation after this and don't reconvene until February. So our expectation certainly is they'll do 25. We're seeing quite a few signs that the economy is starting to turn. So I'd be very surprised if they went further than that.
What would you regard as the neutral rate there? I mean, 2.25%, potentially saying could go as low as 2%. I mean, that would obviously be very stimulatory.
Yeah, certainly neutral rates. Would be more somewhere in the low to mid threes. So policy is now clearly stimulatory. It's just taken a long time to feed through. There was a lot of very long-term hedging after the ultra low rates in that post-COVID period. So I think consumers and firms are now finally coming through to lower rates as that hedging rolls off.
And how's that playing through for individual sectors? I know you're seeing what you're seeing in the property sector at the moment. What are you watching there?
Yeah, look, there's been a couple of significant raisings, which has just put a little bit of a lid on what had been an almost 20% bounce by the sector in the June and September quarters. But the sector still yields 6.5%. Term deposit rates are down to 3%. I think the current little liquidity shortage, thanks to about $500 million of raises, will soon pass through, and people will be back to chasing the yield. And in terms of the fundamentals, cap rates have stopped expanding and may start to tighten a little bit. And we're starting to see some really good signs of absorption. For example, Argosy property, which tends to own a range of more sort of workman-like office and industrial properties, if you will. I mentioned over the last couple of months, I've seen a surge in tenant inquiry such as they haven't seen for many years. So that's really encouraging.
Matthew, elsewhere, Infratil, note that you're seeing that share price is coming under pressure. It does, of course, has that exposure to data centres, and that broader sector there is obviously feeling a bit of heat at the moment. What are you seeing there with Infratil?
Yeah, I mean, Infratil's sort of the New Zealand economy is very different to the New Zealand market, and Infratil is one of the reasons for why. It's a large part of our market. Massive data centre investor via Canberra Data Centres, and it's about 9% off its recent highs, as we've started to see some of that AI trade unravel a little bit. It's quite a low risk way of playing a data centre trade, as most of their investments are 20-year plus leases with very deep pocketed counterparties in the Magnificent Seven. Well, interestingly, they are looking at doing a deal with the new kids on the block in Australia, Firmus, which I think would be widely viewed as a much lower quality counterparty with some fairly colourful backgrounds there. So we'll see if that happens or not.
There are indeed some colourful backgrounds, but obviously that a lot of people are very bullish, particularly in regards to Firmus. Matthew, another dual listed stock, we're going to take a look at A2 Milk. Actually, that's done very well of late. What's actually driving that?
Yeah, look, A2 actually tends to be driven a lot by Australian growth investors, and it's had a very strong run indeed over the last year, as you're showing there. A2 has done extremely well, winning market share in the competitive Chinese infant formula market. There's now on pretty extended valuation multiples, forward PE in the high 20s, current PEs in the mid 30s. Their AGM comments the other day were solid. Some minor upside to investors, to people's forecasts, but they were mainly just driven by the weak Kiwi dollar rather than any further upgrades in infant formula sales in China.
All right, and Matthew, just look at the gentailers. I note that they've been holding investment days, but more broadly, we're seeing this side of the ditch as well. Just the vast amounts of capex being spent, particularly in the generation businesses. What are you seeing there?
Yeah, look, the gentailers are unusual beasts here, with the exception of Contact, which is 100% free float. The others are 50% owned by the government. Similar to Australia, there's a lot of angst about wholesale power prices, and so there's a lot of pressure being applied to the gentailers to make further investments, particularly as we have a real gas shortage in this country now, given the moves by the former Ardern government to ban gas exploration, and gas-fired electricity generation's always sort of had previously been the marginal generation source. So the concern for the sector is that perhaps some of these companies may be pressured into doing low returning investments. So that's something we'll certainly be keeping an eye on over the next little while.
Matthew, enjoy the week. Thanks for joining us some Soul Funds Management.
Pleasure. Thank you.
All right, so let's take a look at where we're likely to get going, as bearing in mind those very steep losses we saw on Friday. So looking for a good bounce back today. SPI futures up 1 1/10%. And we'll get across a bit of news too. There's been a focus on BHP this morning. Looked as though it was going to make another tilt for Anglo American. Anglo American rejecting that. BHP saying no, they're not going ahead with that. So it was on, it's off. We'll take a look at whether that's going to likely benefit the share price or not, and get across some much more as well. Join us in just a moment.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.